You continue to try and boost your presence in India. Tell us about this deal, tell us about the company, and also tell us about the rationale.
Yeah, good morning, Lindsay. We've been in India since about 2007 when we established a joint venture with a manufacturing partner in India. Subsequent to that, we've put an administration office into India. We've also got some regulatory people there who assist our African operations. And the next logical step for us really was to go front end into what is really a very fast growing pharmaceutical market. So it's about a $16 billion market, so not insignificant in global terms. It's growing at about 16 to 20% compound per annum. And we were fortunate to find a business that's been established for about 40 years in the Indian market, turns over around about R250 million per annum, and markets primarily branded generics to GPs and specialist physicians. Comes with a very strong sales and distribution presence across 27 states in India, and with about 1,000 medical reps on the ground. So we're really excited about the opportunity to get into the front end there.
How difficult is it to get into this market? I mean, you said you're fortunate enough to find this particular company and this opportunity. What are you going to do with it? I mean, you've got an admin office there, you said. Do you grow the business yourself? Do you let it grow organically? What is your strategy?
Yeah, we're fortunate that we sort of put the cart before the horse a little bit here. We hired a very experienced pharmaceutical exec in India about a year ago. A gentleman, in fact, who's worked in Nigeria, he's worked in the UK, and has worked at some big pharmaceutical companies in India as well. So he sort of established our presence on the ground ahead of this transaction. Certainly there's decent organic growth. So if you look at the categories in which this company operates, they're all showing growths in the sort of mid-teens, gynecology, dermatology, etc. But we believe there's a real opportunity to introduce some of the products that we make in our joint venture in Bangalore into the front end in India, and hopefully gain some traction with real Adcock Ingram brands over time.
It's, I mean, when you look at China and you look at India and South African companies look at them, you think to yourself, well, goodness me, there's so many people, there's so much growth potential, and these are the real economic tigers of the world, and therefore there must be guaranteed profits. But if you try to get into the telecommunications business, for example, the mobile telephony business in India, you would realize that competition is extremely fierce, and it must be extremely fierce as well in pharmaceuticals and drug making. What are the margins like, and are you in danger of getting swamped by tiny margins and maybe making a mistake and actually sort of losing your footing with this one?
Yeah, Lindsay, you're right. It's a very crowded market. So in India, you have about 6 real big players, and some of them hold as much as 5% market share. But outside of those 6 players, you've got about 5,000 other pharmaceutical companies in India. So one can imagine how crowded that space is. And even though this business only turns over, as I said, about $250 million a year, it ranks just outside of the top 50 in India. So you can see that even a relatively small or medium-sized company is still quite a big player in that Indian market. So margins per se are not particularly different to what one would experience, in fact, in our market here. And if we look at operating margins in this business on a turnover of about 200 to 250 million, they're generating operating income of close to 60 million rand per annum. So it's not particularly different to what we would experience here in South Africa.
Are you, this is maybe an unfair question, Andy, but I've got to ask it. Are you under pressure because of the extraordinary international growth experienced by Aspen Pharmacare with their aggressive acquisition policy internationally? Are you under pressure yourselves from shareholders to do exactly the same? And is this part of a strategy to try and play catch up? Sorry for that question.
No, it's not an unfair question at all. We think Aspen's done a real good job with its international strategy, and their performance speaks for itself. Our shareholders per se have not been really fanatical about us going offshore. So, you know, when we unbundled from Adcock, from Tiger Brands in 2008, we explained our strategy of moving the business over time into emerging markets, and primarily that was Africa, outside of Southern Africa, and India. So generally, our shareholders have been comfortable with where we're going. We definitely need some geographical risk diversification. That's the primary motivation for going offshore. And the second one is to access markets that aren't growing as well as South Africa. And certainly India, given that we've been in business there for 5 odd years, is a business where we believe we understand the market, we understand the people, and we can do well in that market.
Very good. So you're going to focus on that. Well, you obviously focus on that with this $86 million or 720 million rand acquisition. So that's great. Where next? You've got to obviously get a foothold in another jurisdiction somehow and replicate what you're doing in India. It's a very slow process. It's a very competitive process. But can you give us any idea of where it might be next?
Yeah, absolutely right, Lindsay. We've got a decent business in East Africa, and we've got a very good business in Ghana that's listed on the stock exchange there. But certainly I don't think we can call ourselves a proper African player until we've established a business in Nigeria. So Nigeria is a territory that we are looking very hard in at the moment. We're turning over a lot of businesses. And then ultimately we also think there are a couple of jurisdictions in North Africa that are attractive for Adcock.
Well, I'm very glad you said that, because you think to yourself India and China, as I've said before in a previous question, but right on our doorstep is a continent that's starting to fulfill its potential, and it's been a perennial underachiever, but suddenly we've got these extraordinary growth rates from African countries, albeit off a low base in many cases. But as you say, Nigeria is right there, growing at a phenomenal rate, both in terms of the economy and the population. But again, how difficult is it to get in there, and how much of a crowded space is it from a drug making point of view?
Yeah, it's proving a challenge. We've looked at a few businesses. We've even got close to offers on a few businesses. But really what we're looking for in Nigeria is something similar to what we managed to find in India. So we have to find a business with a really strong sales and distribution capability and a real branded presence in affordable medicines. And that is proving a challenge. And certainly we're not going to jump in until we found the right business. We're not going to throw money at something that's not going to grow Adcock.
As for shareholder value, when you look at Adcock Ingram and you look at the sector in general, do you consider yourselves at the moment to be a defensive play? Do you think yourself a defensive and a growth play given this type of deal? What would you say to a potential shareholder?
Yes, certainly if you look at our Southern African business, which is still more than 90% of the company, we are a very, very strong cash generator. So despite some of our concerns around current consumer slowdowns in South Africa, and certainly we don't think that consumers have as much cash in pocket as they would have had 18 months ago, we're still generating very healthy cash flows. The margins in the business here are strong, and we think that we can continue to satisfy investor concerns around returning cash to shareholders and at the same time growing the business. If you look at Africa and India, the types of businesses that are available for purchase in those jurisdictions are seldom going to cost more than R1 billion, and on average are generally going to cost a lot less than R1 billion. So we can continue to return cash to shareholders and grow the business inorganically.
Andy, thanks very much for your time this morning. That's Andy Hall, the CFO of Adcock Ingram, on the occasion of the announcement of an $86 million acquisition of Cosme Farma in India.